Welcome back. You're still tuned into Trading Hour. The market is picking up just a little bit, so it's now around a 60-point cut that we have for ourselves on the Nifty. The mid-cap index is actually pretty much in line with the frontliners this morning, so it's around 0.4% lower. And the Nifty Bank has also picked up just a little bit. It's around 0.3% in the red. But let's do one thing. We'll talk about the mutual fund data for the month of September, which came across yesterday. Now, September saw over 14,000 crores of equity inflows, but this also has a large chunk. So over a third of this amount is from new fund offers. Around 5,800 crores of this amount is from the NFOs alone. Now, if you take a look at the debt funds, the outflows continue here. So the figure is at over 65,000 crores. And of course, this is led by the liquid funds, which saw over 60,000 crores of outflows. Now, an interesting trend that we saw is that balanced advantage funds, which, for several months have been a very popular category. They have seen an inflow this time of around 524 crores. But if you take out the NFOs from this, it's actually an outflow this time. So that's an interesting trend that we picked up, and we'll track how this moves, in the coming months as well. And finally, on the SIPs, we have seen a good figure with the contribution at almost 13,000 crores. So to discuss the data that came through for the mutual funds for the month of September, Sunil Subramaniam, Managing Director and CEO of Sundaram Mutual Fund, joins us now. Sunil, good morning and thanks for joining us. This is Pavitra. First on the total inflows itself, yes, it's 14,000 crores, which, doesn't look bad, but a big chunk of this is from the NFOs. So if you take that out, the figure, of course, is not quite as healthy as that. Do you think that this is some amount of sort of worry or uncertainty creeping into the market now?
Not really. If you segregate this data a little bit more, you will see that month-on-month redemptions have been flat. So which means that people's concerns about redeeming their existing funds is not there. So that's one strong signal of confidence which you'll see in the underlying data. The second, as you mentioned, is the sharp uptick in the SIP on a month-on-month book by almost, I think, 500, 600 crores. It was about 12,400 odd last month, and it's about 13,000 crores. That again indicates. The third is, if you look at the composition, now you mentioned about 6,000 crores from NFOs, but the point of the matter is, if the redemptions are flat, it means there's new money coming into the industry from either bank deposits or other financial asset classes. That's again a healthy trend of inflows. And finally, if you look at the composition of the breakup of the funds this time, when you take away the passives, I think the ETFs got about 10,000 odd crores, but you see mid-cap and small-cap funds have been the ones grabbing apart, and then sectoral thematic, which again, I think there were business cycle funds and the like which were launched. So the point is, I think that the Indian investor is getting a little more mature. He's figuring out that in a world which is in recession, India is still doing well. So focus on the India specific areas, which is mid cap, small cap, business cycles, I think all the lot. The other aspect also, which is a pointer to the growing confidence of the retail investor in the Indian economy and the markets, is the shift away from balance advantage. Now, balance advantage is typical play safe. When there is volatility, when you're worried, is when you tend to increase allocation, because then you're trusting the fund manager to shift within debt and equity. But the fact that if you take away the NFO in that it's come to negative, it means that there is a reallocation of money away from balance advantage into active equity, which is again a growing sign of confidence of the investor. So there are lots of pointers here which indicates a more maturing and a more confident retail investor in the country. And that's a good sign in the times to come.
But Sunil, the whole premise of selling the balanced advantage fund was downside protection in a market like this. And, wouldn't it then be appropriate to increase allocation now? But that aside, the equity allocation is not increasing at the pace to mutual funds as one would have liked or anticipated. Is some of this money also going into, PMS?
Definitely at the super HNI level, there is a lot of money going into PMS and alternates. And if those numbers are not reported by AMFI, but yes, what you say is very true. The HNI is looking at it, because the reason, Sumera, the answer to that is that the fact that balance advantage, and you brought in balance advantage again, right? So the balance advantage funds are actually play safe, is when you don't have conviction. And in a time when the markets are correcting, it's volatile, and international news flows are so much of a headwind, you still find the investor choosing active, which is either you say PMS and AIF, or you say mid-cap and small-cap, which are the higher risk parts of the market, right? So this is what is giving me confidence that the investors making the right choices in times of volatility. You know, this whole SIP, rupee cost averaging, why do we keep talking? It is because you got to buy when the market's correct, which is what rupee cost averaging does. If the lump sum is itself acting in that way, I think it's a good sign of maturity. I mean, I think coming months will also bear out whether this is true. But in a time for the market is volatile, to see equity inflows go up by any amount, I think it's a strong vote of confidence.
Okay, a strong vote of confidence. Sunil, I'm going to throw in a few questions on the market as well, because, you know, you were mentioning the entire setup and we have been talking about what the global markets are looking like. Of course, India is outperforming still in that context quite significantly. But, you know, usually you don't see this kind of decoupling last forever. I mean, and you do see a catch-up pretty soon. So do you think that is sometime soon, or do you think it is still a while away and we will see the markets continue to outperform for a while?
I think our markets will continue to outperform for a while. I'll tell you why. Because while interest rates are being hiked and the market is nervous about that, what does that interest rate hike actually do is what I think we need to focus on. So the first thing the interest rate hike does is makes US debt attractive, right? So to the extent that there is money which is equally choosing between debt and equity, you would expect the debt allocation to go up, right? So that's one flow in the market you will see happening. Investors who have a choice between debt and equity will switch from equity to debt, and that's why the equity markets are volatile. That's number one. But second point of this is that interest rate hike is actually going to bring on a recession, right? Because it's killing demand in the US. You already saw US housing loan interest rates have gone up from 2.5% to 6%. That's the impact of the rate hike. So demand is naturally going to get killed, right? So then in that scenario of the killing of demand, then you're going to see softening commodities. So if you then say softening commodities, including oil, then you search, right? Because there's still $30 trillion of QE money of the G4 countries floating around in the world. If they may remove 100 billion a month, 200 billion a month, that's 30 trillion. But look at the size of that pool. Now that money, how much of that is equity to debt? I don't think that's very shiftable. There are equity investors, and equity investor, debt is one. Second is within that, India market is about $600 billion of FII flows. So this delta that happens, right, happens in a risk money, between let's say a commodity exporting country which benefits in rising commodity inflation time and will lose money in commodity deflation, right? So countries which have heavy commodity exports like Brazil tend to get benefited when commodity prices rise. But now, with an interest rate hike, you can see that commodity deflation is the order of the day. And so there will be a shift of capital out from commodity exporting countries like Brazil and the like to a commodity importer. 83% of oil we import. So there is a reallocation of capital, which I expect where India will be the beneficiary, number one. Number two, the commodity deflation will positively impact our economy itself. So forget about flows. The economy itself, you see, even right from FMCG to auto to fertilizer, there are so many of our sectors use oil as an imported derivative. Their input costs have been under pressure for so many months. Now the commodity things have started easing. That story, if it's going to continue, it means corporate margins are going to be healthy. India's fiscal and trade deficit pressure will be less. So to look at it that way, right, reallocation of flows will happen to that country which has a better economic future. There will be volatility in the short term because news flows tend to make people act. But bottom line, money has to find its level. Money can't remain idle. So when Brazil markets will go down because of deflation, it has to find an alternative heaven, and that's where India will show itself up. So I strongly believe that this flow of risk capital, the risk capital itself may reduce because of the recessionary forces. But whatever risk capital remains, India's allocation, I think, will tend to grow and will support our markets, and the commodity deflationary scenario will benefit our thing. Then from a domestic sector perspective, you obviously focus on the domestic oriented sectors. Why? Because the factors which will affect India as an economy are the export side. So if the world is going to a recession, you would expect exports to naturally suffer. So placing your bets on a domestic cycle where the government plus PLI plus private sector capex is strongly driving GDP growth, which is a supply-driven GDP growth, is less likely to get affected from a recession than an heavily export-oriented economy, like many emerging countries are. So to that extent, the impact of recession will be there on India. IMF has already revised from 7.5 down to 7 to maybe 6.5. But still, 6.5 in a world tending towards zero growth is, I think, a very good outlook for us to be a magnet for foreign capital. And FDI flows are not ceasing. FDI flows continue to be strong. So I would tend to put focus on domestic-oriented sectors and say that India will still be an attractive market. And these words like coupling, decoupling, are big words. Right? I don't want to use those kind of words, but to say that if you have $30 trillion of liquidity, simply, it has to find somewhere to invest, right? It's not all going to...
All right, we take that point that you think that, even in this situation where even, though the US might head into a recession, India perhaps looks much better placed. So we take that point. Sunil, thanks a lot for joining us and taking us through your call in the market as well as the mutual fund data. It's time for a short break, but when we come back, a whole